Today, you are going to learn how to avoid the dreaded tax torpedo in your retirement. So, the first thing to understand is what is a tax torpedo? A tax torpedo is a situation in which you've been on a certain standard of living, you're living at a rate where your taxes are actually very low in retirement. So, example being you retire at 64, you're living off of some social security, maybe some investment income, maybe a little bit off of an IRA, but you're in a very low tax bracket and you're actually not even paying taxes on your social security. And then what people don't understand is when they wake up at age 73, the government imposes what's called a RMD, a required minimum distribution. And so you wake up at 73 and all of a sudden the government says, "Hey, we need you to pull more money from that IRA so we can tax you." And when you pull from that IRA, it raises what we call your provisional income. And once your provisional income gets to a certain level, you either have a 50% of your social security becomes taxable or 85% of your social security income becomes taxable. And so what happens is not only do you skyrocket, now you're paying, taxes on 50 to 85% of your social security income, but you jump a tax rate. So maybe you're even at a 0% tax rate or you're at a 12% tax rate and you jump to a 22 or a 24% tax rate. And so what people don't understand is that can be avoided, but it's not something that you can just flip a switch. You can't just wake up and say, "Oh my gosh, I'm 73, time to do this strategy where I don't have to pay RMDs anymore." It's something that has to be methodically done really between the ages of 59 and a half and 73 years old. You can certainly, if you're watching this day and you're 70, you're 68, you certainly still have time to either minimize, reduce, or eliminate these taxes, but it's based on your situation, your account value, your age, your income, as far as how this applies. But what we're going to do today is show you in general how this can work and educating you on how to be prepared. What we're first going to do is show a study of a married couple. They filed jointly, but we're going to walk it back in time. So they're just now retiring. They're 64 years old. Because once again, I can't just show you at 73 and say, "Hey, this is how it worked." We're going to show based on 64 and walking into the future when they turn 73, how this can be not only impactful, but avoided. And so at 64, their IRA balance is 1.2 million. They're going to have a social security income of $35,000 a year. They get some dividends or capital gains off of investments, $15,000 a year. And then they're just taking IRA withdrawals for fun. So let's just say in this example, they take a big family vacation and another trip once a year, and they're going to spend $10,000 a year out of their IRA just for fun. What that relates to when it comes to income and taxes is their provisional income, which is one half of their social security income, their investment income, and their IRA, adds up to $42,500 a year. Their provisional income after their standard deduction, which they automatically get to take off of their tax return to reduce their tax bracket, is only $13,300 a year. So at age 64, they're actually paying $0 in social security taxes. So their social security is not taxable at all. And then they're only paying a total taxes $3,200 a year. So they're paying very minimal taxes. In theory, they're in the 12% tax bracket, but their effective rate is only 5.38%. But now we walk it forward. So this is the thing that the 64-year-old typically is not thinking of today, is that if you're not spending from that IRA, even on a conservative basis, compound interest is still on your side. And so that IRA, even if it's invested conservatively, is going to compound and keep growing. So even at a 6% rate of return, that 1.2 million turns into $2 million at age 73. Your social security income still 35,000, investment income 15,000. That's assuming, those have probably grown too. And so that's probably gone up, but we're being conservative in this example. But here's the catch. Now the government knocks on the door and they say, "Hey, congratulations, you have $2 million in your IRA, but we need you to spend, and we're mandating that you spend $80,000 a year out of that IRA so we can tax you." Let that settle in. $70,000 more that you, in theory, don't need, they're going to make you pull so they can tax you. And here's the effects. Now at age 73, here's your income and taxes. Provisional income skyrockets to $112,500 a year. Even after that standard deduction, it's $83,800 a year. Now you're paying an additional $2,800 in Social Security taxes. And now your taxes went from just over $3,000 to $12,282 a year. You're in the 22% tax bracket, but your effective tax bracket is 9.44%. So that is where, all this sidebar, a lot of people dismiss this, saying, well, my effective rate's only going to go up 4%. Well, onlys and but to a $9,000 increase. And what we tell people is, why settle? Why surrender $9,000 more or even go up 4% when it can be avoided? And so here's the way around it. So the available tax strategies for these clients is, one, we've identified that they have an opportunity between 64 and 73 to fill up their 12% tax bracket. So what that means is there's a $63,500 a year gap that they could shift money from their IRAs and 401ks into a tax-free environment. The example being a Roth IRA, they do a Roth conversion and withhold the taxes on this different money on the 12% bracket without bumping them up the tax bracket. So their ability is that over 9 years, they could shift $571,500 over that 9-year period. So it's not an overnight process. They're doing it over 9 years so they don't raise their tax bracket. And the total taxes spread out over that 9-year period, and you add it all up, they pay $68,580 in total taxes over that 9-year period. Another thing that they can do is what's called a qualified longevity annuity contract, or a QLAC in short. You can take 25% of your IRA balance and put it into one of these annuities. And the concept is that QLAC is actually favorably designed where you can defer this money until the age of 85. It avoids the RMD. You don't have to pull it. And at age 85, now you start to take an income stream from this annuity, where this is extremely favorable for retirees, especially only in a situation where you don't need the money, is now you get to a point where you can spend your qualified dollars between 73 and 85, spend down those dollars at the lowest possible tax bracket. Now you start getting into your Roth dollars, which are tax-free. So the majority of your income is now tax-free, and you're taking a very minuscule amount from this annuity. So your standard deduction is probably reducing or eliminating whatever amount is taxable on this portion of money, because at age 85, you're not spending as much money. And even if you are, you're pulling it from the tax-free bucket, which is off the grid of taxation point. And the last thing, and this is case by case on the amount that you can do. Let's say we tax loss harvest 15,000. So we try to negate our capital gains and find investments in the portfolio that are down that we can use to reduce the taxes. And so these, if they went and they did these things, this would be the effect that they could have in the changes at age 73 to avoid the tax torpedo. Using these tax strategies, they can save $201,000 in lifetime tax savings. They're now paying they have a 0% tax on their Social Security. And most importantly, that RMD is fully eliminated by the standard deduction. So now they only have to pull $26,000 a year instead of $80,000 from that IRA. And the standard deduction is $29,200. So now it's being fully eliminated by their standard deduction. So now they don't, now they in theory don't really have a tax on the RMD. And here's the thing that a lot of people miss is, in this case specifically, this is money that these people weren't going to really touch anyways. They weren't needing it. So not only did we avoid $200,000 for unnecessary taxes, but now we've put money that can cook and it can bake and grow in an environment tax-free. And when they pass away someday, now they're said to pass on $1.6 million to the next generation tax-free. So this is just a little bit of information and insight on what you personally can do and implement into your retirement planning to avoid the dreaded tax torpedo.